Hey there, Jeremiah Nolen here with Next Phase Advisors. Market down 20%. What do? Well, if you're a day trader, you panic, you sell, you try to time the bottom, and you usually get it wrong. But if you're a pension manager, you do absolutely nothing. And I'm going to show you exactly why that works, and more importantly, how you can think the same way. Because here's the thing, pension managers aren't smarter than you. They don't have a crystal ball. They can't predict the market movements any better than anyone else. But they have something you probably don't, a system that's built to ignore market volatility. And today, I'm going to show you how you can build the same system for your retirement. So let's start with what happens when market crashes. March 2020, market drops 34% in the month, fastest bear market in history. What did most investors do? They panicked. They sold, they moved to cash, they locked in losses. What did pension fund managers do? Nothing. Literally nothing. Why? Because their essential obligations, their monthly payouts to retirees, those are already covered. The market dropping didn't change the fact that retirees needed their pension checks, so the pension checks kept going out like clockwork. And you know what? The market recovered, and those pension funds, they recovered too because they didn't panic sell. Now let's contrast that with the average retiree. So they've got $750,000 in their 401k. They're retired, they need $5,000 a month to live. So if the market drops 30%, now their 401k is worth $525,000. But they still need $5,000 a month, so they pull it out from a declining account. They're selling low, they're locking in losses and reducing the base that needs to recover. So the market comes back up, but they're recovering from a much smaller starting point. And they're still pulling out $5,000 a month. This is sequence of returns risk, and it's brutal. But pension managers, they don't have this problem. So why not? Because they've already separated their money into buckets before the crash happens. They have guaranteed income covering essential obligations, and then they have growth money that can let ride through volatility without touching it. That's the safe bucket blueprint framework. So here's how it works. Your safe bucket. This money is that's allocated to protected lifetime income. So Social Security, pensions if you have them, other protected lifetime income sources. This bucket pays you a check every single month, regardless if the stock market is doing. Market up 20%, you get your check. Market down 20%, you get your check. It's predictable. It's guaranteed. It covers your essential expenses. And here's the key. Because your essential expenses are covered, you don't have to sell anything in the market. You're not forced to lock in losses. You're not panic selling. You're doing exactly what pension managers do. Nothing. Now your freedom bucket, this is liquid cash, money markets, short-term bonds, other sources, enough to cover 2 to 3 years of discretionary spending. Want to take a vacation? Freedom bucket. Car breaks down, freedom bucket. Help the kids with something, you guessed it, freedom bucket. This money isn't in the market necessarily. It's not subject to volatility. It's just there when you need it. Now your growth bucket, this is your long-term money, stocks, diversified portfolios, real growth potential. And because your essentials are covered by the safe bucket and your short-term needs are covered by the freedom bucket, you can let this money ride through markets ups and downs without panicking. You don't need this money for 10, 15, 20 years. So temporary 30% drop, it's just noise. You wait, the market recovers, and you benefit from the full rebound. That's how pension managers operate, and that's how you should too. Let me give you a real example. I had a client who retired in early 2022, NASA employee, about $450,000 in his thrift savings plan. He was worried. You know why? Because the market was at an all-time high. And he read enough to know that retiring at market peak is risky. Sequence of returns risk. It's the market crashes right after you retire and you're pulling money out. You could be in trouble. So here's what we did. We structured his retirement using the safe bucket blueprint. His first pension, $3,000 a month. His Social Security, we had him wait until 70. That's going to be about $3,200 a month. His wife's Social Security, about $2,000 a month. That adds up to $8,200 a month in guaranteed income before we even touch the TSP. His essential expenses, about $6,000 a month. So right there, he's covered. The safe bucket is handling his essential expenses with $2,000 a month to spare. Then we took about $50,000 from the TSP and we put it in his freedom bucket, liquid, for discretionary spending, emergencies over the next couple years, vacations, grandkids, things of that nature. The rest of his TSP, growth bucket, stays invested, let it grow. Then what happened? 2022 was a brutal year for the market, down 18%. Did he panic? Nope. Did he have to sell anything? Nope. His pension and Social Security kept paying like clockwork. His essential expenses were covered. The TSP dropped in value, sure, but he wasn't touching it. So it didn't matter. 2023, markets rebound. His TSP recovered and then some. Now he's got more money in his growth bucket than when he retired, and he's been living comfortably the whole time without worrying about market timing. That's the pension manager strategy. Now, compare that to someone who retired with the same 450,000 but didn't have the safe bucket structure. They're pulling $5,000 a month from the TSP. Market drops 18%. Now they're at 369,000 minus the 60,000 they've pulled out over the year. They're down 309,000. Market rebounds, but they're rebounding from 309,000, not 450, and they're still pulling $5,000 a month. Fast forward 10 years, they're in trouble. Same starting point, same market conditions, completely different outcomes. Why? Structure. One person engineered their retirement like a pension manager. The other person is just hoping their account balance holds up. Here's what most people get wrong. They think retirement planning is about accumulation. How big can I get this pile of money? But pension managers don't think that way. They think about distribution. How do I turn this pile of money into a reliable income that lasts a lifetime? Completely different mindset. Accumulation is about growth, taking risk, maximizing returns. Distribution is about predictability, reducing risk, maximizing reliability. You cannot use an accumulation strategy for a distribution problem. But that's what most people try to do. They retire with a 401k full of stocks and they just start pulling money out and hoping the market cooperates. Pension managers, they separate money first. Guaranteed income for essentials, liquidity for short-term needs, growth for long-term. Then when the market crashes, they're fine because they're not dependent on the market for their monthly expenses. That's the strategy. That's the system. That's how you sleep at night when the market drops 20%. Now, is this strategy for everyone? No. If you don't have enough money to fund a safe bucket that covers your essential expenses, then you might need a different approach. And if you're someone who loves managing your own money and watching the market every day, this might feel too conservative for you. But if you're like most retirees I work with, and you just want to know that your essentials are covered so you can stop worrying about market crashes, this is the way. Think like a pension manager, not a day trader. Separate your money by purpose before you retire, not after the market crashes. Build guaranteed income for essentials. Keep liquidity for short-term needs. Let growth money actually grow without panic selling. And when the next market crash comes, and it will, you'll do exactly what pension managers do. Nothing. Because you won't need to. Let me say it again. Because you won't need to. Now, if you've made it this far, you're clearly serious about protecting your retirement from market volatility. So let me ask you to do something. First, smash that like button. I'm serious. If this video helped you understand how to think differently about market crashes, let YouTube know by hitting that like button. It helps the content reach more people who need to stop panicking about market drops. Second, subscribe to this channel if you haven't already. Turn on the notifications. I put out retirement planning videos every single week, real strategies, real client examples, no hype, no fear mongering, just practical ways to build a retirement that works. Third, leave a comment below. Tell me what's your biggest fear about market volatility in retirement. Are you worried about timing, sequence risk, pulling money out during a crash? Let me know in the comments. I read every single one and I use your questions to create future content. And finally, if you want help building your safe bucket blueprint so market volatility stops keeping you up at night, That's what we do. Schedule a complimentary consultation with Next Phase Advisors. Links in the description below. We'll look at your situation, figure out what your essential expenses actually are, map out your guaranteed income sources, and show you how to structure your portfolio so you can think like a pension manager instead of a day trader. No cost, no obligation, just a detailed plan for how to build your market-proof retirement. I'm Jeremiah Nolen with Next Phase Advisors. Market volatility is inevitable, but panic is optional. Thanks for watching. See you in the next one.